This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi, welcome to the latest monthly bonus podcast from the AJ Bell Money Markets team, all about investment trusts. I'm Dan Coatsworth, and joining me is Laith Khalaf. Hi there, Laith.
Hello, Dan. Yeah, we've got a few treats for you on this episode, including a chat with Paul Angell, Head of Investment Research at AJ Bell. He's going to be talking to us about how to research and select investment trusts.
Now, JPMorgan Global Growth Income has fast become one of investors' favourites. But did you know it has a sister investment trust that follows the same investment strategy but just looks at Europe? I'll be talking to the manager of this trust later in the show.
And Tom Sieber and Martin Gamble will also be with us to do a deep dive into Greencoat UK Wind, which is, it's fair to say, a fallen star in the investment trust world.
First up, we're going to discuss some of the big news events over the last few days.
Yeah, so Dan, should we just start with just looking at what trusts are doing well and which ones are not doing so well so far this year?
Yeah, definitely. I know that we're obviously only a couple of months into the year, but there's some really interesting trends I thought is worth sort of pointing out on the market. So when I ran the data, the best performing trust so far this year was Ground Rents Income. Now that had a takeover approach by Victoria Property, but actually just as we're recording this podcast, that deal has fallen through. So that share price has given back a little bit. But really the ones that have stood out the best are emerging markets or China specific ones. And I think this is really interesting. Investors have been looking at the US market for the best gains for years, thinking that's where, North America's the place to make money. This year, that's not the case. So we've had the JPMorgan Emerging Europe, Middle East and Africa Trust is up 27% in the first couple of months of the year. This is really interesting because it used to be mainly focused on Russia, had to sort of tilt its approach in the last couple of years, and it's now looking at emerging Europe, Middle East, Africa. Really what it's sort of saying is that Saudi Arabia, South Africa and United Arab Emirates will continue to be sort of the main focus of the index that it's tracking. But really what it's trying to do here is looking at particularly at financial, materials and communication sectors, also a bit of energy as well. So there's sort of the main sort of sectors here. It's a tiny trust. It's only £23 million. I think we're in this era where tiny trusts seem to be merging with other stuff. So I don't know what the sort of the longer term future of this will be, but it's interesting to see it moving higher. Bailey Gifford China Growth Trust and Fidelity China Special Situations, they've both done very well as well, sort of between 16-20% gains this year. So with China, we've had there's been concerns about sort of slowdown in the economy, in sort of the rate of economic growth. But actually, China came out recently and said, yeah, we hit targets of 5% for last year. And I think that's sort of perhaps given people a little bit of confidence that things are okay. On the worst side, I mean, Laith, put you on the spot. What do you reckon is the worst performing sort of perhaps part of the world or sector over the last couple of months?
Well, I know that India hasn't done very well, but that's
Yeah.
because I had a look over your shoulder at some of the data you were running. Is that right?
You're cheating.
It would be bad if I cheated and got it wrong. That would be embarrassing. So just tell me it's India.
Yeah, India is definitely one of the worst ones. So India Capital Growth down 18%, Ashoka India down 14%. India's done very well over the last sort of quite a few years, but people are getting a bit concerned. The market's looking a bit expensive, so it just looks like a slight pullback. Infrastructure's not been in favor at all. So things like renewables, infrastructure group down 13%. Digital 9 infrastructure essentially halved in value this year. And what's happened here is it's trying to be selling some assets, but it's not been getting a very good price for them. So it recently sold Subsea Atlantic, an Irish fibre business, Aquacoms at a 32% discount to the valuation it's booked. And that follows another sort of deeply discounted sale there. So clearly not doing very well. The other one that caught my eye was Augmentum FinTech, down 13%. So this is sort of investing in challenger banks and the type of sort of the future of the financial services industry, sort of technology-led lenders and banks. I think it's quite interesting here because you've had the traditional banks have been doing very well on the stock market for the last couple of years. To see the tech ones struggle is interesting. Some of these challenger banks don't really make any money. They might have hoovered up loads of customers, but as a business, they're not profitable. And I think that perhaps risk appetite is slightly dwindling this year. So, I mean, those are just some of the things. Well, I think what we'll do is perhaps at the half year stage on the podcast, we'll do a bit more, it's sort of a bit more analysis about what's going on there. But um, let's turn attention to new trusts joining the market. We've been very thin on the ground for new investment trusts IPOs for a long time, but things are actually looking up, aren't they, Laith?
Well, we've had another trust coming onto the market. I guess you could kind of think of it as kind of good news or bad news, because yes, it is an IPO on the market, but what it's doing is it's another activist investor. So we've talked quite a bit about this and on the Main Money Markets pod about Saba Capital. This is another one that's raised money and floated on the market. It's called Achilles. So it's raised £54 million so far. It's got another 150 million shares in the pipeline, which it can deploy over the next 12 months or so. So potentially that if the share price stays at where it was launched, which was £1, that potentially gives it a cash pile of 200 million pounds to play with. And what it's doing is similar-ish to what Saba's doing. So it's an activist trust. It's going to be managed by Harwood Capital Management and the chief executive, Chris Mills. He's worked on exit for investors in Hypnosis, the song investment trust that got into a little bit of bother last year, wasn't it? I think, Dan.
Yeah.
And the focus for this trust again is going to be closing discounts and trying to release value to shareholders that way. It's going to be focused on actually less liquid areas of the market, so alternatives, which almost certainly means property, infrastructure, and renewable sectors. Now, the Achilles is basically saying in these sectors there's an average 30% discount, and there's a £39 billion gap between the market value of the trust, the shares in the trusts, and the assets, the underlying assets that those trusts own. So this trust is going to try and own one or two trusts at a time, up to a maximum of 5. So, looking at it from the outside of this kind of Achilles trust, it's going to be pretty undiversified. It's not going to have very many holdings. And its approach is probably going to be different to Saba. It's probably not going to be as quite as combative. I mean, that's probably not hard, but I think this is a bit more friendly fire. Harwood managers, they run an investment trust, Atlantic Smaller Companies Trust, and in its prospectus, the trust is basically saying that it wants to resolve issues privately with the boards where possible, but it is willing to go public as well. So we'll see how it goes. It's obviously a bit of a different beast to Saba because it's targeting those liquid assets. So potentially looking at selling assets, selling the investment trusts to buyers, possibly mergers and restructuring. Obviously, with the liquid assets, there is a question of how do you sell them, because they're illiquid, right? So that means they're difficult to sell, and that valuation gap, that those discounts in the sector might also just be obviously a reflection of demand, but they also might be a bit of a reflection of the market saying we don't fully trust the valuations that are implicit in those net asset values. And it's quite interesting, if you look at the structure for this new trust Achilles, then it's got a charge of 1%. And it's also got a performance fee attached, which applies if it makes more than 10% on a trust from the point at which it buys in. So, given that it's saying that the average discount in these sectors is 30%, it's obviously setting a much lower bar for its performance fee to come in and actually fully closing the valuation gap, which maybe, as I say, suggests that it doesn't think that it can get all the way necessarily with all of them because of the lack of liquidity and possibly doubts around the kind of valuations that are put on those particular assets. So, we've covered Saba in detail on various podcasts in the past, so do check those out. But we've also got something else interesting in investment trust world going on with Bill Ackman. Dan, what's he been up to? Making comparisons between himself and the sage of Omaha, I gather.
Yeah. Yeah, there's a couple of things with Bill Ackman I thought is worth pointing out. First is he's got an investment trust on the UK stock market called Pershing Square Holdings. Now, I know that we've covered, like you say, we've covered Sieber a bit, but there was a really interesting article in the Financial Times a couple of days ago, which it was a bit sort of tongue in cheek, but it made the point to say that Sieber, as an active investor, has come along and targeted various investment trusts, but there's one which is surprised it hasn't targeted, because really it's got everything it's looking for, i.e. it's trading at a deep discount, and nothing that the manager seems to do seems to have narrowed that discount. So, and it's talking about Pershing Square Holdings. So what Sieber's new sort of push is to try and convert some investment trusts into open-ended funds, and it thinks that essentially Pershing Square Holdings it literally is ripe for doing this. So whilst this is, like I say, it's a slightly tongue-in-cheek sort of style of article that was written, it's an interesting thing because everyone's sort of saying like, well, Bill Ackman hasn't really got huge support in for this London investment trust. It's there, it's ticking away, but really he's so much more focused on the US market. What could be done? So behind the scenes of his Pershing Square capital management business, essentially this is his asset management business, he's trying to at the moment take a majority stake in Howard Hughes. So this company already makes up about 10% of the London listed investment trust Pershing Square Holdings, but he wants to go from owning a minority stake to owning up to 69% of this business. So it's a real estate corporation, and what he wants, and by doing that, essentially he would convert the asset management side of Pershing Square into a large financial group. So this is where it has real similarities to what Warren Buffett does with his Berkshire Hathaway vehicle. So Berkshire Hathaway, it actually owns businesses. It's not simply just taking equity stakes here and there. And actually, Bill Ackman said on Twitter that he wants to follow in the footsteps of Warren Buffett by doing this. So one to watch, but it is relevant because Howard Hughes is one of these big stakes in this sort of the London listed investment trust. So like I say, we'll revisit that story if there's anything new on it. But finally, just before we sort of wrap up this news section, Laith, I know that you've got some interesting stats on unit trusts versus investment trusts.
Yeah, these are actually from James Carthew of Quoted Data, who's a friend of the show. I think have we recorded him friend of the show status, Dan? I think we have, haven't we?
I think we can stay it now. He's been on many times.
Okay, good. Yeah. So, so he's been very vocal about the kind of Sieber Capital and their arrival. But he's pushed out some data which I think is interesting, just comparing investment trust sectors and open-ended fund sectors, looking at performance over the last 10 years. And the data shows that basically in 15 out of the 21 sectors where there's some comparison to be made, your investment trusts beat open-ended funds, and in some sectors by quite a considerable amount. So, in the global sector, for instance, your investment trusts in that sector outperformed unit trusts or open-ended funds by 46% over 10 years. There was a huge divide in the tech and technology innovation sector, where investment trusts outperformed by 242% over 10 years. So there were some notable failures by the investment trusts. So in North America, investment trusts underperformed their open-ended cousins by 51%. So there is a divergence in performance here, and I guess the question is why? Why is that? James argues that it's the investment trust structure that is helping to do that, and I think there are reasons to believe that the investment trust structure could help with performance. One thing is, I guess, that managers aren't looking over their shoulders at flows because there's a fixed pool of capital, so they're not managing money coming in and out. That gives them greater time and focus on their portfolio. They don't have to sell in and out of their portfolio simply because people are buying or selling the trust itself, which is what happens with an open-ended fund, and that's also particularly useful, of course, for liquid assets. As we saw in the property sector, if you've got an open-ended fund and you have lots of withdrawals, then a lot of those funds had to gate withdrawals because they couldn't sell the underlying properties. So, there's definitely kind of a good story to be told, I think, about investment trusts there. One of the other things which I think is important about investment trusts, and which can lead to greater returns over the long term, but is also an additional risk, is gearing. So investment trusts can borrow, and many do borrow to invest. So what you would expect is that over the long term, that borrowing is done at a lower interest rate than the rate of return the investment trust can make with that borrowing. You would hope so anyway, particularly over the last 10 years or so, when for a lot of that period, interest rates were really low. And what that does is that should magnify returns over the longer term. It does mean that kind of in downdrafts, you can see greater falls from investment trusts. So it's not a free lunch. It does come with some risk, but that's another potential reason why we've seen those investment trusts outperforming over the long term. I think it's probably worth saying that for some sectors, there are actually really few investment trusts in some sectors. Which kind of means that you kind of get into a stage when, if you're looking at the sector, perhaps what you're looking at is actually more fund sort of strategy specific returns, rather than just this is an investment trust, this is an open-ended fund. It's not quite as clean a comparison. So, for instance, something like the UK all company sector only has 6 trusts in it. So if you're comparing performance of those 6 trusts to all the open-ended funds, actually it might be a bit more, not just about kind of investment trust versus unit trust, but actually how have those six managers actually done? What are their strategies? So I think it was an interesting bit of research that kind of came across my desk. I think, as I say, kind of there's a good story there to be told about investment trusts. I do wonder sometimes, Dan, whether we get a bit too kind of hung up about fund structures, about investment trusts versus unit trusts, because from where I stand, the kind of actually it's kind of important to think about that, but there are other probably more important considerations. For instance, where you're allocating money, where in the world you're allocating money, what your manager, what their strategy is. What the charges for your investment are. Particularly kind of with more liquid investments, I kind of feel like the investment trust versus unit trust kind of dynamic is perhaps of lesser importance than those things. But I do think, Dan, with Sieber now coming in and trying to convert investment trusts to open-ended funds, I think that's going to really polarize opinion. Because you kind of have to pick a side, don't you? Investment trusts or open-ended funds. It's kind of a little bit like the Brexit of investment trusts. I guess this kind of big kind of polarizing event, and I think we'll probably get quite a lot of people saying, singing the praises of investment trusts or open-ended funds as this saga does continue.
Yeah, obviously we've got Paul Angell coming on the show a little bit later. He's got some really interesting things to say about how you go about selecting investments, because he's got a sort of similar approach, whether it's a unit trust or an investment trust. But stand by, you'll hear that a little bit later in the pod. But should we bring on our first guest now, though?
Yeah, so absolutely. We teased at the start of the show, I think there was a Euro-specific alternative to the popular investment trust JPMorgan Global Growth and Income, and it's been doing pretty well over the past year. Dan recently caught up with the manager Tim Lewis to talk about the trust. Let's hear what Tim had to say.
Well, JPMorgan Global Growth and Income is one of the most popular investment trusts among UK investors right now. So, Tim, am I right in saying that JPMorgan European Growth and Income shares a similar investment process, but obviously it's focused specifically on continental Europe?
Yeah, exactly. That's fair to say. I think the core of what we do looks very similar to JGGI, as we call it. If you take things like the resources that we have at our disposal, so the proprietary insights we get from our team of global fundamental analysts, but also the leading edge quant tools that we have at our disposal here. We're also looking to construct our portfolios to come up with a similar outcome, which is a core balanced portfolio that we believe can outperform in different market environments. And of course, the structure of the trust is the same too. So that enhanced dividend structure which allows us to pay an attractive quarterly dividend without impacting on the investment decisions of the portfolio manager.
So what sort of companies are you looking for here? Is this sort of high quality businesses, sort of sitting on lots of cash, not much debt, sort of thing, or is this sort of a broader sort of remit that your sort of a shopping list that you have to go through?
Yeah, it's a good question, and I always slightly reluctant to answer that because everybody's looking for the same things, right? They're looking for high quality companies that are attractively valued with good momentum, and but that is what we're looking for. And I would say it's not necessarily high quality in that it's only high quality, but rather better quality than the market is currently pricing it at. Because obviously just seeking out high quality leads you down high valuations all the time. So I think what we look for is the quality of the company, as in the returns that they're generating, the quality of the management team, the decisions that they're making. We look at the valuation across a number of different metrics. But what's very important for us as portfolio managers is looking at the operational and price momentum of the business as well, particularly on the operational momentum of the business. Are things improving, both at a macro level and a micro level?
So obviously you're going after growth and income. How does it work in terms of, do you say like half the portfolio we just focus on sort of dividend paying companies and the other ones we're looking for sort of good strong earnings growth, or do you not have a sort of a very rigid framework to follow?
No, very good question. And we don't have a framework like that. Luckily for us, Europe in itself is quite an organic to yielding market. So our yield without even looking for one is about 3.5% today. That's without seeking out those ideas. But what we're looking at is every single company on the same basis, which is the total shareholder return. So it's a combination of those things. So there's obviously stocks that we look at and we like because of the yield they pay, but we're also happy to own stocks that don't pay a dividend yield. And we don't specifically think we have to match up one against the other.
Yeah. Okay. So, I mean, I was looking at some of the sort of performance stats. So JPMorgan European Growth Income shown really good performance over the last 12 months, just over 10% share price return. It's outperformed quite a few popular global funds, including JPMorgan Global Growth Income, which is up 8.5%. I think some people might be a bit surprised about that. You don't have exposure to all these sort of big US tech stocks, which seem to be driving markets over the last few years. So what sort of factors or market trends have been contributing to sort of you as a European focused manager's portfolio outperformance?
Oh, it's a good start. I wasn't actually aware of an outperformance. We sit beside the team at JGGI, so I'll make sure to repeat that when I get back to the desk. I think the first thing I would say is it's actually not that unusual. If we look back at over our past 10 years, the share price and NAV have grown at roughly 10% a year. I think it's 9.6, 9.7 a year. So it hasn't been an abnormal year for us last year. In terms of what's been working for us, generally we try to build a balanced portfolio that we see performance coming from different areas of the market. But I think particularly, you mentioned US mega cap tech, and that's something that a lot of column inches are devoted to. A lot of people speak about it. And it is something that sometimes we look enviously on, right? As European investors say, I wish we could have exposure to NVIDIA and others. But I lumped recently, because we were doing a presentation, US mega cap tech's up around 30% over the past year. You hear a lot less about European banks, which are up around 50% over the same period. And actually, if we even extend that to 3 years, again, it was US mega cap tech up around 75%, which is an exceptional performance. The European banks are up 100% over that same period. So I think partly, there's been real strength coming through in the European market that's probably underappreciated and just isn't talked about in the same way because they're not the household names like Apple and Meta and Microsoft that people love to click on and read about.
I mean, obviously banks are being very good, but are you sort of seeing gains from a much broader base of industries, sectors?
Yes, as you say, banks have been good, and financials in general have been an area of strength, but it has been broad-based. And so if we look back at our top 5 performing stocks over the past year, for example, they come from 5 different sectors. We get stocks with very different business drivers, stocks that perform at different times. And, we believe that's a positive symptom of the balance that we're trying to create in the portfolio. In most years, when we look back, we like to see that. We like to see the attribution from our performance being evenly split across the sectors, and that has been the case. Performance coming from telcos, coming from software, coming from the financials, as mentioned already.
I mean, I think Europe's probably pretty misunderstood by quite a lot of investors. I think people think it's just sort of full of domestic earners, but actually, if you look at sort of some of the big companies, they do earn pretty much around the world, don't they? So, I mean, do you think this is obviously is this an advantage to you that's misunderstood because you can essentially buy stakes in companies that are potentially undervalued, certainly relative basis to some of their sort of US peers?
Yep, absolutely. I think, I'm reticent to say that anybody misunderstands it, and investors have been right to be focused on some of those US names over the past number of years. What we do find, often when we talk about valuation discounts, Europe versus the US, if you talk at a market level, you get some pushback because people say, oh, well, the sector composition is very different. And then you talk, okay, well, here it is on a sector neutral basis. And we look at it and say, even if we accept that Europe trades at a discount, it's at a much wider discount than it has been throughout a long history. But I think the thing that's most compelling to investors when we put it forward to them is looking on a stock-by-stock basis. So if you look at a stock like Capgemini versus Accenture, or Novo Nordisk versus Eli Lilly, or the European banks versus the US, look at stocks with similar fundamentals and say, well, why are they trading at such a large discount? That's when often that the valuation discount becomes most apparent.
Yeah, I mean, just probably worth clarifying. So in terms of your portfolio, you're looking at Europe, but you're not looking at the UK, are you, at all, in terms of the market?
Yes, no, we've got as you're probably aware of, the stable of investment trusts here at JPMorgan, and there's kind of the UK focused ones already with Claverhouse and Mercantile and UK small and mid cap. And so we are Europe ex UK, essentially.
Yeah. I mean, and just as just recording this, we've just had general election in Germany. Last year we had change government in France. I mean, Europe's definitely going through a lot of political change. Does that impact your investment decisions at all, or is it something you just need to be aware of but not be guided by?
Yeah, it does impact. It's definitely something we need to be aware of, right? At the very least, it's something that we need to be aware of from a risk control basis. And I think that's more how we think about it. We think about our portfolio exposures. Are we balanced to different political outcomes? Because ultimately, we don't really have a real edge in predicting those. We think we are good at picking the best stocks. So we try to minimize the noise that is coming out of some of these things. But at an overall level, we do also look back and say, again, one of the pushbacks sometimes to investing in Europe is just that there's always something going on, right? There's always an election in one country or another. There's always a negative macro data point coming out of one part of the region. But the kind of evidence of its relative unimportance can be seen in our historic performance. So I mentioned that, over the last 10 years, it's been a particularly turbulent time politically for Europe, through Brexit, through the pandemic, through the war in the Ukraine, everything that you said about France and Germany, but it's not that abnormal a period. And through that all, we still managed to grow at around 10% a year. So I think it's important for us to say the status quo isn't, you don't have to wait for everything to be perfectly aligned to invest. You just need it to not be any more difficult than it has been over the past 10 years.
I'm not sure if you've got any companies in your portfolio which are perhaps in the automotive sector or exporting to America, but clearly Europe's got this reputation of having lots of companies that make things and they sell into the States. So clearly the return of Donald Trump is something that people are front of mind. They're wondering what will happen with trade tariffs. I mean, does that have a direct impact on the companies that you're currently invested in?
Certainly has a direct impact, and we see it. I think how we look to manage it as portfolio managers, it's probably raised the policy uncertainty. And as I just mentioned there around, it's not something that we have a really strong edge in predicting. And woe betide anybody who tries to predict what Donald Trump is going to do next. So really how we look at this is there's probably more risk control happening in our portfolio today than than would be in a normal period. But over the long run, we still believe that the value is in finding the right stocks that grow through this period. And so we just make sure that we balance the portfolio not to be caught offside um, in either eventuality. Because a lot of what happens here is a rhetoric gets priced in very early into the markets, and actually, Trump's a deal man, as he says, and his first hardline stance might not be as strong when negotiations end, in which case we could actually see a relief rally for a lot of European equities. So we just try to make sure that we have a balanced exposure through those different eventualities.
I mean, if someone's got a global fund in their portfolio, what would also in having a European fund add to it? I guess it's a different flavor or style of companies there, potentially cheaper ones. But why else might someone be interested in Europe?
Yeah, I think a lot of it comes down to the diversification that we get through Europe at a sector level and at a stock level, and particularly since global markets have increasingly become US markets because of US outperformance, and US markets have been increasingly become tech funds because of that outperformance. So, we're really seeing, the move that's coming into European funds at the moment is coming from people who are questioning that, because we've had that period of outperformance. We're seeing that cool off now. So, on the one hand, you have the Mag 7 missing on elevated expectations. And on the other, you have these improving economic data points coming through in Europe, or like we talked about, the European banks, much maligned for the past 15 years, who've now just marked in this reporting season their 18th consecutive quarter of EPS upgrades. So, it takes a while for that strength to come through. But I think what we're seeing is global investors looking to reallocate back into that more diversified view and a kind of a stronger economic output coming out of Europe.
I mean, just sort of final question. I mean, how are you feeling at the moment in terms of the outlook for this year? Are you sort of optimistic or slightly nervous, or cautiously optimistic? I guess you can merge them all, can't you?
Yeah, exactly. I think, listen, we are feeling optimistic. Every portfolio manager, I think, needs to have some part of their brain that's wired to, I don't even like saying that out loud. So I would say cautiously optimistic is probably a good way, but we're always cautiously optimistic. But I think, or rather, we're always cautious, even in our optimism. I would say we are more optimistic than we have been for a number of years. And that's because, a lot of what's happening in Europe now is similar to what we look for in stocks. We find often the best opportunity that happens in stocks are when expectations and valuations are low, and when you're starting to see improving outcomes coming out of that. So momentum is improving, and it feels like that's really happening in Europe at the moment. So, financial conditions are easing from incredibly restricted levels. Economic indicators in the region are now improving. The City Economic Surprise Index, for example, in Europe is now turned positive, just as the US has turned negative. And that's, again, coming from a very low base. We recognize that, but it's this from a low base improvement which can really add value. We find, and potentially, other positive catalysts coming. We talked about the German elections and potential for the debt brake to be restructured there, or an ending of the war in Ukraine. So we're seeing this positive momentum already happening. We can see positive catalysts that might be there into the rest of the year. And then we're also seeing signs of investor appetite coming back to Europe. And that, we haven't mentioned the discount, but we're at a wide discount, and we've kind of always seen that Europe is trading at a discount to the US, and the investment trust is trading at a discount to its NAV, this sort of double discount. And as we see investor appetite coming back, we think that discount can narrow, and so that leads to the optimistic view.
Well, Tim Lewis from JPMorgan European Growth Income, thank you very much for coming on the podcast. It's been great to talk to you.
Thanks for having me, Dan.
Okay, that was Tim Lewis from the JPMorgan European Growth and Income Trust. Now, we've had a few people get in touch asking for us to mention the stock market codes for the trusts that we feature, as some of you may refer to them in that way. So for clarity, JPMorgan European Growth and Income Trust is JEGI, and JPMorgan Global Growth and Income is JGGI. So yeah, a little bit of a few acronyms for you there to throw in.
Good. I'm going to test you on that next week. Laith. Check that you've remembered all these codes.
Okay, I'll keep my notes.
Yeah. So let's bring on our, we have regular people from Shares Magazine, the journalists come on the show. They're incredibly knowledgeable, and we've asked them to do a deep dive into an investment trust that's been nominated by one of our listeners. So they selected Greencoat UK Wind, or UKW as it's also known. So here's Martin Gamble and Tom Sieber to explain what it does and what's been going on with the trust.
So we're talking about Greencoat UK Wind today, and that's partly inspired by the fact that we had a request from a listener, Darren Caproli. Hello, Darren, who noted that it was a popular fund that with a very generous dividend policy, but that the shares had been under real pressure. Before we get into why that might be, for those who don't know the trust so well, I thought I'd just give a very quick snapshot, and then I'm joined by Martin Gamble, who will take us through some of the background. So Greencoat UK Wind is an investor in operational UK onshore and offshore wind farms, and it generates sufficient electricity to power 2.2 million homes. It aims to deliver regular income from this portfolio, which it can return to shareholders. And it also looks to increase the dividend in line with inflation, and has paid out more than £1 billion in dividends since it IPO'd more than a decade ago. It also looks to invest excess cash flow in additional operational assets, and notably, it looks to maintain exposure to the latest UK power prices by not fixing the price of the power it sells over the long term. So that's, a very quick snapshot of what the trust is and what it does. But Martin, could you give us a bit of the background and also why it's trading at such a significant discount to the value of its assets?
I'll give it a go, Tom. Yeah.
Yeah,
So,
good luck.
I mean, this was the first listed UK renewable company. So it is one of the first companies to come to market, and notably, it is the only UK domiciled trust. A lot of them are domiciled outside the UK, and they've done a very good job, I think, over the decade since they listed. As you mentioned, they aim to try and beat the increase in RPI, and they've done that. They've achieved a growth in NAV of around 60% versus 56% for the RPI. So they've delivered the growth in the dividend and the growth in the NAV. So they're growing the real value of the assets as well as providing a nice income. But to get to your question about the discounts, I mean, it's affected all investment trusts. And really what set it off a couple of years ago was the rising interest rates as the governments around the world try to fight inflation. And what happens is, because these cash flows are long-term and steady, they are valued off a cost of capital, which is based on interest rates. So as interest rates go up, the theoretical value of those cash flows come down. So that affects the NAV. So it becomes a headwind against the growth that they may be seeking. But there's some other reasons too. Another factor is the consolidation we've seen over the last couple of years in wealth management and fund management. So that's increased the scale of those groups, which means they have larger capacity requirements, liquidity requirements when they're investing, and these trusts just too small, some of them. And there was a study by Winterflood this year, and in that study, only half of the clients were willing to invest in investment trusts less than 200 million market cap, and that's down from almost all of them a few years ago. And another concern was that there was just generally lower liquidity in the investment trust space, which were putting them off investing. So they also want to see more consolidation within investment trusts generally. So all these factors, I think, feed into the discounts, and they become almost persistent discounts now, and quite deep too. So I think that's what's really been worrying investors. But they're the principal reasons why the discounts exist.
Yeah, that's a really useful summary. I mean, it's probably worth saying that Greencoat is one of the larger trusts, if not the largest, isn't it, in the space? So it won't be as affected by that kind of concern, of big institutions about liquidity. But certainly the discount has been persistent, and while not the largest in the sector, is still sizable. I mean, the trust has been proactive in terms of looking to address this discount. So it recently completed £100 million share buyback, and alongside its full year results on the 27th of February, it announced another £100 million buyback. I mean, you do wonder if it's good money after bad, because the first one doesn't seem to have moved the needle too much, but obviously it does at least show that they're trying to do something about the fact that they're trading at this heavy discount. Perhaps more interestingly as well, the company recently announced its first disposal. So in December, it sold a 40% interest in 2 wind farms to a Japanese buyer, and that allowed it to pay down its borrowings, which obviously it's got more expensive to borrow as interest rates have moved higher. But it also and it kind of helps fund the buybacks, but it also supports the credibility of the asset value, I guess, doesn't it, Martin? Because the deal was concluded at the prevailing net asset value, so that sort of backs up, the fact that the net asset value is real. It's based on something.
Yeah, absolutely. I mean, it does do that, and I think the other thing about buying back shares at a discount, it does add value to existing shareholders who don't sell the shares and hold on. So it does increase the value of the company. So it's good use of cash. And yeah, I think there's a debate, isn't there, whether buying back shares does actually reduce discounts. I mean, the evidence suggests that it's a mixed, and it doesn't really do much. But I think in terms of adding value for shareholders, good use of cash, you can increase the per share value of the NAV just by buying back shares at a discount. And of course, investors can reinvest those dividends too. So if, with interest rates potentially coming down, or at least not going up, the pressure from those higher costs of capital will reduce. These companies, not just Greencoat, but others in the sector, have also been reducing their short-term cost of funding as well, and their leverage. So that will help. And for investors reinvesting those dividends, if they does get back to NAV, the share price does get back to NAV, there's quite a nice return to be made if you're patient.
Yeah, that's an excellent point. Yeah, potentially, so obviously.
Discounts are a feature of investment trusts rather than a bug, I would say. Sometimes they trade at discounts, sometimes they trade at premiums. This is life.
Yeah, that is life. And you're right to make that point, because it's not always been the case that Greencoat UK Wind and other renewables trusts have traded at discounts. In fact, prior to I guess 2021, they quite frequently traded at a premium to the value of their assets. So you can't rule out that happening again. I mentioned that the company recently had full year results out. There was one other kind of key detail or kind of development, I suppose, that was announced alongside that, which was that one of the long-running managers of the trust, Stephen Lilly, is stepping down. But I think probably not something for investors to get too concerned about. The replacement, a guy called Steve Packwood, has a lot of experience, and they're backed by a large team there, aren't they now? Partly thanks to the deal that was done with Schroders not that long ago.
Yes, this is one of the largest renewable teams in Europe, and they have around $1 billion assets under management, I believe, or even more. So it's backed by the whole Schroder team, and it's a deep bench. And yeah, they got bought out 3 years ago. So I don't think there's anything to worry about in terms of the quality of the people running the businesses. No.
But the other thing, I guess, has been about wind generation, or the amount of wind and the type of wind that they've been getting, which I guess is inherently unpredictable and hasn't necessarily been in the trust's favour more recently.
Yes, so they do track the long-term wind in the assets they have, and they against the 20-year mean, there's been like a 2% shortfall since they've been listed, and they've projected that may continue in the future, and so they've lowered their longer-term assumptions about the wind, how much wind there will be, by about 4%, which will lower the NAV slightly. And it's just one of those things, isn't it? Intermittent. That's just the nature of the energy source. And I did ask the manager, Matt, about that, and he said he wasn't. I asked him, does it mean revert? Are there any chances it could get back to the mean? And of course, they don't know.
No,
I don't think it's a linear relationship that things just get back to some mean. But that's something to be to consider. But I don't think it's a large issue, especially in light of the amount of renewable energy, green energy that the UK needs over the next few years if they are to hit their targets. We're looking at a fourfold increase in offshore and a doubling in onshore just to get close to the UK government's targets by 2030. So there's plenty of more work and capital to be put into the sector.
Absolutely. And you mentioned there that the wind has sort of consistently been below their expectations, and yet they've continued to be able to deliver it, particularly in terms of the dividend. So not necessarily something to get overly concerned about.
Yep, I think they've done a good job. I mean, since listing, they've generated around £2 billion of cash flow. Half of that's gone into dividends, which has grown in line or higher than inflation, and they've spent just shy of £1 billion in reinvesting into the assets to maintain their value. So those numbers speak volumes, I think.
Yeah, I mean, and beyond their own efforts to reduce the discount through buybacks, and they are talking about doing further disposals, having done this deal in December. I guess they just have to hope that that the backdrop will be more helpful to them in the future, really.
Yes, that's the noise coming out of the sector generally, isn't it? That those sort of headwinds will disappear, and I think it's a fair assumption at this point.
So thanks there to Martin Gamble and Tom Sieber. And just a reminder, if there's a particular trust you'd like us to discuss on the pod, drop us an email. It's podcast@ajbell.co.uk with your suggestions, and we'll do our best to feature them on a future show.
Yeah, now it's time for our final guest, and it's Paul Angell, AJ Bell's head of investment research. He's here to discuss how to research and select investment trusts.
So, Paul, thanks ever so much for joining us. I think I'd like to start the conversation by just getting your viewpoint about the general process for picking an investment trust. So if one of our listeners fancied putting some money into an investment trust, what do you reckon the best starting point is?
Yeah, thanks, Dan. Well, as with any investment, the best starting point is to consider how this new holding will fit in with your wider portfolio and investment goals. Is it going to increase or reduce diversification from your existing holdings? What's your time frame? Is there a particular investment outcome you're trying to achieve, be it income, capital growth, or even inflation protection? From there, you can more confidently begin your investment trust search. For example, say you already have a relatively balanced mix of investments, but do the regular income stream, then an income-paying investment trust could be a great solution for you. Or perhaps you have a long-term investment horizon and you want to grow your capital as much as possible, and you can stomach the volatility along the way, then perhaps some of the private equity, tech or biotech trusts could be of interest.
Obviously, in your job, you're constantly looking at the different range of products on the market. I guess you probably over the years have refined a process. What you personally, Paul? What's how do you sort of select a trust?
Yeah, sure. So to a large extent, actually, our investment trust selection process is very similar to our open-ended fund selection process. Firstly, we screen the particular part of the market we're looking within by size. So we're typically looking for trusts that are kind of over 200 million. So from that, we think they're going to be viable going forward. They're not a threat of further future consolidation. And we're also at that first kind of screening level, we're looking for funds that aren't kind of prohibitively priced. So below 1% from a annual management charge or an ongoing charge perspective. From there, we then got a kind of long list of investment options to look at, and we then will look at the typical portfolio exposures of a trust and whether these meet what we're looking for in this area, i.e. what's the typical investment style within the portfolio. Is there a geographical allocation mix that is kind of typical, or maybe market capitalization, so large caps, small caps, and also we would be looking at the liquidity profile of the investments at this stage too. As well as that, we kind of layer in a view on the asset manager themselves, whether they're credible and committed to the UK marketplace, and kind of that's our kind of first kind of narrowing down of a list, and from there we can then assess the performance of the remaining trusts that we have on our list. So here we're looking for performance over what we believe would be an appropriate time frames. We're looking at over 3 or 5 years, and we'll be looking against an appropriate peer group. So trusts that have kind of aligned within those earlier stages of our process that I mentioned. Typically, as I say, we're looking for kind of 3 to 5 years performance history. We're looking for trusts where the lead manager has been on the trust as name lead manager for that whole period. Sometimes investment trusts are managed in a team-based process, and so you can look further back, but invariably the length of the management of the current lead manager is a good period to look over. So that's kind of all our desk-based analysis, and from there we've kind of got a good idea of what we think is a good investment opportunity. So at this point within our investment process as kind of a professional organization, we would then go out and meet with the fund managers themselves on the most interesting looking trusts. And within these meetings, we're seeking to understand the manager's investment philosophy and process, i.e. what the inefficiency that they're seeking to exploit within the market is and how they're looking to do that. Also within these meetings, we're trying to assess their overall caliber as an investor as they talk us through their experience in markets, how they've navigated various ups and downs, whilst also trying to ensure from our perspective that the typical holdings and therefore likely performance profile of the trust that we'd kind of pre-identified is in line with what the manager expects on a forward-looking basis as they manage the trust. So naturally, listeners will be unlikely to have the opportunity to meet with fund managers on a one-to-one basis. However, there are lots of resources online where investors can undertake elements of this qualitative stage themselves across trust websites, the annual and interim report and accounts of trusts, and we also find the AIC, the Association of Investment Companies website, to be a great starting point for retail investors to this end. Anyway, so we've done all our desk-based analysis, we've met the managers, we're convinced in their strategy's ongoing potential. So at this point, my team or myself will write up a recommendation paper detailing why we think we should hold or recommend the trust as a business.
Obviously, you mentioned a good point there that obviously our listeners might not have the chance to meet with fund managers, but I think increasingly we are seeing more videos available online where you either an interview or presentations. Certainly, obviously, on this podcast, we interview fund managers regularly, and on the AJ Bell website, we have videos. We also try and do events as well. So I think the direction of travel is quite good in terms of giving retail investors access to the people making those decisions. But obviously, appreciate that not everyone will be able to ask all the questions that they want. So hence why it's really good opportunity for obviously someone like yourself, Paul, to perhaps you can talk about the things that you've seen in his meetings. And what one question that comes up quite a lot, certainly when I talk to people, is that when they're going out and they're looking for what to buy, they'll find an open-ended fund and find an investment trust, and they're run by the same people, and they're a bit confused about which ones do they buy. So what if you're presented with that sort of situation, how do you pick which ones sort you think have the advantage?
Yeah, sure. Thanks, Dan. So, I mean, it comes down to a range of factors, really. I mean, firstly and most pertinently, arguably, is whether or not the additional features being utilised or available within an investment trust structure are being used by the fund manager, and whether they're beneficial versus their open-ended fund. So within this kind of realm, we're looking at the approach to gearing taken within the trust and whether that's been effectively applied in the past. We're also looking at the income features within the trust and whether they enable it to boost and or defend income versus an open-ended equivalent. And that's obviously for those funds where you're looking for a consistent or growing income to be part of the return profile there. And then also from a kind of trust vehicle perspective, are there less liquid assets that the manager is able to hold in the trust that improve the portfolio's long-term prospects that wouldn't be able to be held in an equivalent daily dealt fund? Those are kind of some of the features around an investment trust vehicle setup that we're considering. But then beyond that is kind of a more basic question around, well, which is cheaper? from an ongoing management perspective. Sometimes there can be quite a gap in the actual ongoing charge between an open-ended and investment trust, which might otherwise be very similar. So obviously we'd go for the cheaper in that instance. And then finally, we'll be looking at how the price of the trust compares to the value of its underlying assets, its NAV, whether or not it's trading at a premium or discount, that is, or another way to think about that is, are you over or underpaying for the underlying assets within the portfolio? But we don't just look at the premium or the discount. We look at how structural that premium and discount is, or is this a current divergence at the moment, or might you anticipate that divergence widening or narrowing in the future? Because something's at a premium or a discount at the moment doesn't necessarily mean that it will return to NAV anytime soon.
Yeah, I mean, are there some sort of classic mistakes that people make when they're doing their research process and looking for an investment trust?
Yeah, well, I mean, I think the first kind of classic mistake goes beyond investment trusts, goes beyond fund selection, goes to kind of any investment, which is to assume that past performance is an indicator of future returns. So that's the kind of first major error people make. And then specific to trusts, probably three things I'd say there. Firstly, getting into too niche an investment area. Niche investment opportunities are a feature and often an attraction of investment trusts, but people really need to think about what they're buying into before they're investing. Do they understand the underlying kind of exposures that they're taking? There are trusts out there investing solely in aircraft leasing or European logistics, real estate, or biotech, life science businesses, or even direct infrastructure lending. So these are very niche, particular areas of the market that I think it can be a mistake for people to kind of blindly head into. Other mistakes specific to picking trusts. One that I kind of touched on earlier would be assuming that a trust trading at a discount will soon return to NAV. Not necessarily the case. Discounts can be extended for a long time and can get wider, as we've seen in recent years. And then maybe finally, around trusts that are paying out income, some trusts pay out income out of capital reserves. So the old adage of robbing Peter to pay Paul, those trusts will likely underperform an equivalent trust that is building up its capital reserves and not paying out that income over the longer term. So that's something to be aware of when picking those higher income paying trusts.
So, Paul, obviously you've done all this hard work and you've put together an investment trust select list. So could you perhaps explain what that exactly is, and then maybe run through a couple of examples of why certain trusts made your list?
Sure thing. Well, as you say, Dan, within our investment team at AJ Bell, we've curated an investment trust select list, which is an attempt to lighten the research load of investment trust buyers, currently made up of a short list of 16 investment trusts that we believe can deliver their objectives over the long term. Each trust has been through the research process that I described earlier, although it's worth noting that we typically go for more mainstream offerings than some of those niche opportunities that I mentioned earlier. And the base of this is that we think that they can appeal to the broadest investor base within the clients who use our platform. At this point in time, 7 of the trusts on our list, we also include the open-ended fund within our equivalent favourite funds list. Within the UK, that would be Fidelity's Special Values. We also have Invesco Asia, JPMorgan Global Emerging Markets Income. We have Monks, which is run by Bernie Gifford, and they have the Global Alpha fund on the favourite funds list. Personal Assets Trust, which has equivalent fund on favourite funds list as well, and finally Polar Capital Technology 2. And the reason why we have these 7 trusts is that we already like the investment capabilities of the manager, and we believe that they can additionally benefit from something within the trust structure too, either through gearing, holding less liquid positions within the portfolio, or sometimes both. Elsewhere on the list, we have industry-specific trusts in TR property and worldwide healthcare. Here we believe the trusts offer access to interesting opportunities within European property REITs and global healthcare respectively, and we think they're managed by really high quality managers and teams.
That was Paul Angell, and that's everything from us this time. We'll be back with the usual AJ Bell Money Markets podcast later this week. Till then, thanks for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.